Millions of us have retirement savings in a traditional 401k or IRA. If you're one of those people, how much of that money will you get to spend in retirement? You don't want to forget that Uncle Sam wants his share. If you, friends, are one of those millions of Americans with a traditional 401k or IRA, as we mentioned, it's important you understand the money in those accounts is not entirely yours. Barb, how do we talk to people about understanding the tax liabilities within their retirement accounts?
And that's a great question, Ralph. And it really comes down to understanding the buckets of money. We have the tax now, tax later, or tax never, and understanding really what all that means. So when we talk about tax now, we're referring to funds that are subject to taxation upon earning interest or gains. And this includes your typical savings and checking accounts as well as brokerage accounts. And these accounts are funded with after-tax dollars, meaning you've already paid taxes on the money before depositing it. Now, if we go on to the tax later, this encompasses those tax-deferred accounts like your 401k or your IRA. And with these accounts, you're deferring the taxes until you withdraw the money in retirement. And while this could provide maybe some immediate tax benefits by reducing your taxable income during your working years, it's important to remember that taxes will be owed on the distributions when you take them in your retirement. And plus, there's some strict rules and penalties in place to make sure that the IRS receives its share of your retirement savings. And then we can also talk quickly about the accounts that are really appealing to me, and that's the tax never. And this includes vehicles like your Roth IRAs or your Roth 401ks. And the beauty of these accounts, it really lies in the fact that once you've paid taxes on the contributions, whether through direct contributions or conversions, the money grows tax-free, and qualified withdrawals are tax-free when you take them out. So it means no matter how much you withdraw from these accounts, you won't pay taxes on those distributions. So understanding these three different types of accounts, Ralph, it's really important for planning for your retirement. And it really is important to understand how to strategically take withdrawals from these accounts to make sure we're not paying more than we have to in our taxes.
What do we need to know about the rules which apply for taking money out of our retirement accounts? Anything else you'd like to mention about that and RMDs in particular?
Well, there's always rules, aren't there? I mean, and what this rule says is the year that you turn 73, you must start taking a required minimum from those accounts, or there's going to be a penalty. And that penalty is 25% for not taking your withdrawals. So whether you want to or not, whether you need the money or not, you need to take a minimum distribution and then pay the taxes on it. But let's not forget the tax never accounts, which will be the Roth 401ks and the Roth IRAs. Mm-hmm. These types of accounts, they have rules too. And it says that if you've had the Roth for at least 5 years, you can take withdrawals from the accounts and not pay taxes on the amount that you withdraw. And there is not an RMD requirement on these accounts. So if you don't want to take the money out of these accounts, you don't have to.
All right. Barb, can we discuss now some of the strategies to help us possibly lower our tax bill in retirement?
Sure. I mean, lowering your tax bill in retirement, it can make a significant impact on your overall financial health and help keep more money in your pocket, which is really what we want to do. And one strategy is to diversify your retirement accounts, by having a mix of traditional pre-tax retirement accounts like your 401ks and your IRAs, as well as post-tax options like the Roth IRAs, you gain a lot of flexibility in managing your tax liability. Also, a strategy using Roth conversions, converting traditional 401ks or IRAs into a Roth IRA, and having a plan to outline wise distributions from your accounts and staying informed about tax law changes. All of these things can help you stay proactive and help you optimize your tax situation throughout retirement.
Are there some changes to the rules on the horizon that our high-income listeners need to know about right now?
There are always some different things that are happening and proposed changes. For those high income earners, there are things on the table right now that are saying they want to make it more difficult or even take it away, that you're not going to be able to do what's called that backdoor strategy. And that strategy was where you could be contributing to your traditional 401ks and IRAs and then do a conversion into your Roth. And they're talking about if you make over $400,000, that may not be an option any longer. And there's a few other rules that are on the table too. So it's going to affect contributions. It's going to affect conversions. And I really hope we don't go in that direction. But right now, that's something that is certainly being talked about.
Well, January 1 of 2026, our tax laws will be changing as that Tax Cut and Jobs Act of 2017 will sunset. So the bottom line is these are the lowest tax rates that we'll see probably in our lifetimes, right?
It sure is. If we have a 20, 30-year retirement, which most folks will, there's an opportunity there for a lot of changes to happen, especially with taxes and certainly inflation as well. So this is the opportunity right now between now and January 1 of 2026 to potentially look at what can we do to maybe get money more into that tax-free account through possibly using the Roth conversion. There's some other tools that are out there as well to create more tax-free money down the road. So depending on, your time between now and when you're wanting to retire, we've got more options the earlier we start to prepare and strategize. So depending on your situation, there are options available to help us have less taxes in the future. We just need to really review your situation and see what might be prudent for you to do and see if we can't make that happen. So yes, there's always changes happening. And unfortunately, some of these that are certainly being discussed right now, I hope that they don't go through.
So Barb has mentioned, with the current rules and limits for Roth accounts, there are income limits for the Roth IRAs. So those of you who make too much money wouldn't be able to contribute to a tax-free Roth. That contribution limit for Roth IRAs is $7,000 or $8,000 if you were over the age of 50. A Roth conversion is different from a Roth contribution in that a contribution is taking your earned income and contributing that to a Roth account, while a Roth conversion is defined as taking money from an existing retirement account you have and converting it over to a Roth IRA.
Well, and it's really, unfortunately, but it's not a matter of if, but it's when taxes will go up. And, over the past few years, we've seen a lot of changes to the retirement system, and more changes are being proposed. And these truly can impact your ability to lower your income tax bill in retirement. I'd really encourage you to get a tax analysis done today. There's a short window of opportunity like we've been talking about. Ralph and I mention it every single time. We've got a change coming January 1 of 2026. And it just gives us that small window between now and then to possibly make some of these changes so that you won't have that higher tax problem later on in retirement.